Okay, let's unpack this. We're diving into the latest financials for Mahindra Lifespace Developers Ltd, MLDL. We're looking at their first half results for FY26.
Right.
And honestly, the headline, it's pretty dramatic. They've swung from a consolidated loss, just 1 crore rupees last year, to a profit of Rs 99 crore this first half.
That is definitely the number designed to grab your attention, isn't it?
Absolutely.
So our mission today is to, well, dig into these unaudited standalone and consolidated results up to September 30th, 2025. We need to figure out what exactly fueled that pretty remarkable turnaround.
Okay.
But look, before we even touch the numbers, there's a really critical piece of context you absolutely need for a real estate company like this.
Which is?
MLDL uses the completed contracts method for recognizing revenue. It's under IND AS 115.
Ah, yes.
And they specifically noted in their release, and this is important, that the H1 results are, quote, not representative of the current operations. We just can't gloss over that.
Okay, hold on. Let's pause on IND AS 115 for just a second. For anyone listening who isn't familiar, why does that completed contracts method make these half-year results, well, unreliable for judging current performance?
It's actually pretty simple, but yeah, crucial. Basically, revenue and profit, they only get booked officially when a project is fully completed. Think keys handed over.
Right.
So they could sell, say, 1,000 apartments today, that's pre-sales, but if those buildings won't be finished for, I don't know, 3 years.
Then that huge sales number doesn't show up in this half-year's revenue.
Exactly. So the profit we're seeing in H1, it mostly reflects projects finished recently, one started maybe years ago. It doesn't really capture the huge volume they might be selling or acquiring right now.
Got it. Okay, so it's a mix then, a story of past completions, yes, but also intense preparation for the future.
That's a good way to put it.
And speaking of preparing for the future, let's look at those big picture metrics, the ones showing where the growth engine is really pointing. Land acquisition, future pipeline, their gross development value, GDV additions in H1 FY26 were Rs 5,200 crore. That's a massive jump. About 2.5 times the Rs 2,050 crore they added in H1 last year.
Yeah, that GDV number is, I think, the real story for MLDL right now.
Yeah.
It signals future visibility.
Right, because GDV isn't current revenue. It's the estimated potential sales value from land they've just acquired.
Precisely. And that aggressive acquisition pace means their year-to-date GDV additions are now Rs 9,500 crore.
Wow.
Which gives them a total potential pipeline, as of September 2025, of around Rs 46,250 crore. That's huge.
That kind of potential provides a serious runway, doesn't it? Especially as they're targeting that goal of, what was it, 8 to 10,000 crore in annual sales eventually.
Exactly. Multi-year visibility towards that goal.
So what specific assets did they actually add in H1 to fuel this GDV momentum? Any highlights?
Yeah, they made several pretty strategic land deals. There was one in Thane, where they got a project with an approved DP plan. That's significant. But maybe more significantly, they did a major outright purchase in Mahalanj, Pune. That's 13.46 acres. Estimated GDV, Rs 3,500 crore just from that one deal.
Pune and Thane, those are definitely high-demand areas.
Absolutely, high-growth corridors.
Yeah.
And they didn't stop there. They also tapped into the redevelopment market in Mumbai.
Oh, interesting.
Secured 2 more societies in Lokhandwala. That's under their cluster development approach. And that adds another Rs 1,150 crore in GDV potential just from those new additions.
So portfolio expansion is clearly the name of the game.
Without a doubt. That seems to be the top priority.
And expansion like that, it needs capital. So beyond the land deals, how's the balance sheet looking? You mentioned it's strengthened dramatically.
It really has. The company's now cash surplus. That's a huge reversal.
It's surplus.
Yeah. Look at the net debt to equity ratio. As of September 30th, 2025, it stood at negative 0.17, minus 0.17.
Wow, compared to what it was.
Compared to positive 0.26 back in Q2 of FY25. So it's a complete flip.
That swing is incredibly important, I imagine, for a developer wanting to expand aggressively like this.
Oh, absolutely. Going from 0.26 to negative 0.17 means they've shifted from, relying a bit on borrowed funds to actually having more cash than total debt.
Right.
They're financially kind of inoculated for expansion. They've basically built up a large war chest.
Okay, so how did they build that war chest? It wasn't just from operational collections, was it? Though those seem decent.
Residential collections are strong, yeah. They grew 9% to Rs 1,086 crore for the half year. That's good. But no, the real context for that balance sheet strength, that war chest, is the successful completion of a massive rights issue during H1 FY26.
Ah, the capital injection. Right. Let's put some numbers on that.
Sure. It was nearly 58.16 million equity shares.
Yeah.
Issued at Rs 257 per share.
Okay.
Aggregating to roughly Rs 1,495 crore. Almost 1,500 crore.
That's substantial.
Very. And those funds were immediately earmarked for specific things. Paying down debt, funding these new land acquisitions we talked about, and covering working capital.
So that capital injection is basically the direct reason we see that net debt to equity ratio flip into cash surplus territory.
It's the primary driver, yes, absolutely.
Okay, now let's get to the part that, as you said, grabs the headlines. The profit after tax, the PAT swing,
Right.
consolidated PTA after accounting for non-controlling interest just rocketed up.
Yeah.
Rs 99 crore for H1 FY26. Compare that to a Rs 1 crore loss in H1 FY25. That's a powerful number.
It is powerful. But this, I think, is our aha moment, where the nuance really, really matters.
Okay, explain.
To understand that jump, you have to look very specifically at the joint venture, the JV section of their financial statements.
Okay, the JVs.
So while the overall consolidated profit before tax, PBT, for H1 FY26 was about, let's use crores for clarity, Rs 92.34 crore, the contribution purely from the share of profit of joint ventures and associates was absolutely massive.
How massive are we talking here?
We're talking Rs 194.09 crore in H1 FY26. Up from just Rs 72.84 crore in the same period last year. This huge spike in JV profit, that's the engine driving the consolidated profit number.
Okay, so why the massive spike in JV profit? Was it just one of their joint ventures suddenly completing a huge project, triggering that in AS 115 recognition?
Not quite like that, no. Within that very large JV profit figure, we find two specific exceptional and non-recurring gains. These are related more to financial maneuvering than construction completion.
Ah, okay. Exceptional items, what were they?
First, there was an exceptional gain of about Rs 24.5 crore, that's net of tax, which came from modifying the terms of some non-convertible debentures, NCDs, issued by one of their JVs, Mahindra Industrial Park Private Limited, or MIPPL.
Okay, so basically a gain from restructuring debt within a JV. And the second one?
The second was approximately Rs 18.7 crore, again net of tax. This was recognized from the redemption of NCDs by another JV, Mahindra World City Jaipur Limited, MWCJL. So this gain also flowed through that JV profit line. These were, smart financial moves, optimizing the financial structure of their JVs. But critically, they're one-time gains.
Okay, I have to challenge this a bit then. If we were to hypothetically strip out those two non-operational exceptional gains, which total over Rs 43 crore combined?
Roughly, yes.
Would that consolidated PAT still look like such a resounding victory? Or are we looking at a profit figure that's been significantly boosted by smart financial engineering rather than just increased operational profit from project completions?
That is exactly the right critical question for you, the listener, to be asking.
Great.
If you mentally remove those roughly Rs 43 crore in exceptional gains from the reported H1 FY26 consolidated PAT of Rs 99 crore,
you'd be left.
You'd still be positive, but significantly smaller, closer to, say, Rs 56 crore.
Okay.
Now, Rs 56 crore is still a huge improvement over last year's loss of Rs 1 crore, definitely.
True.
But it confirms that the dramatic headline-grabbing turnaround, that was primarily a function of successfully restructuring capital and monetizing assets within the JVs. It complemented the operational completions, but it wasn't solely driven by them.
That context is absolutely vital.
Okay.
Still, let's look at the pure operational sales volume. The consolidated figures combining residential and their IC and IC business integrated cities and industrial clusters. Those sales totaled are 1,419 crore for H1 FY26.
Right. Let's break down that operational side a bit more, starting with residential pre-sales. Remember, that's probably the best proxy we have for current market traction, even if it doesn't hit the profit line immediately.
Okay.
H1 FY26 residential pre-sales came in at Rs 1,200 crore. That represents selling about 1.75 million square feet of saleable area.
I did notice that Rs 1,200 crore figure. It actually seems to lag slightly behind the Rs 1,415 crore they recorded in H1 FY25. Is that a concern? Are they acquiring faster than they're selling or launching?
That's a fair observation to make. You see the explosive GDV additions, but the pre-sales velocity for the full 6 months was a touch slower year on year.
Right.
However, if you break it down by quarter, the story gets more interesting. Q2 FY26 residential pre-sales actually hit Rs 752 crore.
Okay, so a strong second quarter.
A very strong second quarter. That Rs 752 crore reflects a massive 89% growth over Q2 of the previous year.
So the launch strategy really picked up speed in the later part of the half year.
Exactly. The momentum returned. The CEO, in his comments, highlighted the success of key launches. Things like New Haven, that's about 80% sold. Marina 64, Plot B and C, around 50% sold.
Okay.
And they also noted strong reception for Lakewood's H&I, which actually sold out 100% during the festive season in October, so just after this reporting period closed, but it shows the momentum continued.
So the sales are happening. It just seems the launches perhaps needed Q2 to really hit their stride.
That seems to be the case, yes.
Okay. Now, let's shift gears to the other half of their business. The Integrated Cities and Industrial Clusters, IC and IC. This is their industrial and commercial real estate arm. How did that site perform?
That business segment showed, I'd say, stability. Consolidated revenues were pretty consistent. Rs 219 crore in H1 FY26, which is very comparable to the Rs 214 crore they did in H1 FY25.
And leasing activity.
They leased out 35.6 acres in the first half, so demonstrating steady, consistent traction there.
What's their overall inventory look like in that industrial land space? How much do they still have available?
It's still quite significant. Their total gross area across their 6 IC and IC locations is over 5,700 acres.
Wow.
And crucially, they still have 1,561 net leasable acres available. That's across places like Mahindra World City in Jaipur and Chennai, and their Origins parks in Chennai, Ahmedabad, and Pune.
So plenty of potential left there.
Definitely. And the CEO noted they're seeing healthy traction, particularly in Jaipur and Chennai right now. So that reinforces the potential of this kind of steady Eddie revenue stream for them.
Okay, this really paints a picture of a company strategically gearing up, focusing on scaling, backed by that big capital influx.
I think that's right.
And that kind of transition, that kind of growth focus usually requires some organizational shifts, doesn't it? Strengthening the team.
Often, yes.
That makes sense.
So let's smoothly transition
All right.
and look at the key managerial personnel KMP changes. These were approved by the board right at the end of October 2025, just after this reporting period.
Yeah, and it's smart to see these changes not just as isolated HR moves, but probably as part of getting ready for this high-growth execution phase.
Makes sense. What was the main change?
The most notable one was in the finance leadership. Avinash Bapat, who was the chief financial officer, resigned.
Oh.
But it seems amicable. He resigned effective the end of October 31st because he's transitioning internally to a new role as Group FP&A leader within the wider Mahindra Group.
Okay. So more like a promotion or a strategic move within the larger ecosystem, not an unexpected departure.
That's how it appears, yes. So who's stepping into that absolutely critical CFO role at MLDL itself?
They appointed Shriyam Kumar as the new CFO and also designated him as a key managerial personnel, effective November 1st, 2025.
And his background, was he internal?
Yes, he was previously the vice president handling FP&A, costing, and crucially, investor relations for MLDL.
Okay.
And his qualifications look tailor-made for a scaling company, honestly. 16 years of experience, primarily in private equity and M&A. He even spent time with Goldman Sachs Asset Management previously.
Interesting. So they're bringing someone with a deep financial structuring, PE, M&A experience into the CFO seat right after completing that massive rights issue and signaling a big growth push.
The timing seems very intentional, doesn't it?
Yeah.
It connects directly to that new strategic focus on utilizing capital effectively.
It really does. Any other key personnel changes?
Yes, one more KMP change. In the company secretary role,
Sure.
Dijal Parmar was appointed as company secretary and compliance officer, also effective October 31st, 2025. This was upon her resumption from maternity leave. She's got 13 years of specialized experience in corporate laws.
So ensuring the governance structure is solid as they scale up. Makes sense.
Exactly. Robust structure for future growth. So if we want to synthesize the key takeaways for you, the listener, MLDL's story in this first half of FY26 is really fundamentally one of strategic rearmament. That's how I'd put it.
Rearmament, okay.
Yeah. They executed that powerful capital restructuring through the rights issue. That's number one.
Our chest.
Number two, they successfully monetized some existing joint venture assets, which resulted in those significant but exceptional gains we discussed.
The one-offs.
And third, they doubled down hard on future pipeline development with those massive GDV additions, aggressive land banking.
Okay.
So the foundation looks like it's being laid for potentially huge future operational delivery. The balance sheet is definitely healthy now, even if that immediate P8 growth we saw was, heavily reliant on those one-time financial gains from the JVs.
Okay, so wrapping this up, What does this all really mean for, say, the next 6 months, the second half of FY26? The strong GDV additions, the new cash surplus. It all suggests a strategy heavily focused on using that capital to grab future market share, right?
It certainly points in that direction.
They've got the war chest, as you called it. They've got the land bank now, and they've just restructured their finance leadership team.
The stage does seem well and truly set.
So here's your provocative question to think about after this deep dive. Given that successful large rights issue and the cash surplus it created, how might MLDL actually leverage this strategic financial advantage? Could we see accelerated project launches, maybe even more opportunistic acquisitions? How will they use this position to speed up reaching that target of RS 8,000 to RS 10,000 core in annual sales, perhaps even starting in this current half, H2 FY26?
That's the execution test, isn't it? That's what we'll all be watching closely.
They definitely have the fuel in the tank now.
Indeed. Now we wait and see just how hard they decide to step on the accelerator.
We'll certainly be watching. We'll catch you on the next deep dive.